Hi, I'm Jimmy. In this video, we're looking at Mercado Libre, ticker symbol MELI. So we're going to start with the basics of Mercado Libre's business. Then we're going to jump into some of the numbers and finally, we're going to try to come up with a fair value for Mercado Libre stock to see if it's worth investing in today. Now, we can think of Mercado Libre as sort of a combination between, let's say, Amazon, eBay, and PayPal. It really does all of those, except it's located in Latin America. So when we look at their different segments, well, the commerce segment, the biggest segment, is kind of their Amazon portion. It's their e-commerce platform where they sell a bunch of products. Sellers can list their products there and buyers can buy their products, a lot like Amazon. The fintech segment, well, this one's more of in line with PayPal. They do a lot of the online transactions. They process a lot. Many people in Latin America don't have bank accounts. In fact, it's a little over half of the population in Latin America have bank accounts. So the other almost half don't have bank accounts. So Mercado Libre does a really good job of kind of filling that gap. But instead of using these basic segments, I actually think it makes more sense to drill down each individual business line to make it a little bit simpler to understand what they do. So their e-commerce marketplace is a lot like Amazon. And last year, in fiscal year 2024, they put up a bit more than $50 billion in gross merchandise volume. You might see it shortened to GMV. Gross merchandise volume is basically the sum of all the products that they sold. So gross merchandise volume, they did a bit more than 50 billion. That was a new record for them. This translated into about a bit more than $12 billion in revenue last year. Now, they're doing a lot to push this business forward. They already have a bunch of big brand names there. Companies like Ralph Lauren, big clothing companies that you might expect. Again, a lot like Amazon, that it offers a ton of different types of products, high quality products that they try to make it easy for the customers to buy. So they have expanded. They have like a loyalty program, MELI Plus, MELI Plus. They have expanded the number of products that they offer same day shipping for, a lot of 2-day shipping. Again, think like Amazon, except Latin America. So that's the primary thing that this business does. Now, one of the important parts to consider with them is they are really expanding. They're trying to make it simple for people to buy products. And that kind of leads us into their next line of business. And this is their logistics business. So picture you're a seller that you want to sell products on their e-commerce platform. Well, they will ship the products for you. They will ship to whatever customers that are going to buy the products, they will ship it for you. Well, in order to do that, they obviously have to have the trucks. They have to have the shipping network in place. They have to have the airplanes and all set up. They're investing heavily to expand this fleet, their fleet of planes, their fleet of trucks. A lot of money is going into this. Now, they have made it very clear that although they are doing logistics as a business, they are doing shipping as a business, this line of business is not making money for them. Or let's put it this way, they're trying to break even with it. This is primarily there as a complementary business to their financial services, which we'll get to in a second, and to their e-commerce business. So they're like, hey, if we can make money with those two businesses here, we just need to break even. If we could try not to lose too much money here, well, we can make our customer experience better by being able to allow them to ship products through us. They handle the vast majority of all the shipping that happens within their network. They have a little bit more than, I think, 10 plus fulfillment centers that they opened in 2024 alone. That being said, let's now jump over and look at their financial services business, Mercado Pago. Okay, now this business line is more in line with like a Square or a PayPal, where they, process transactions. Now, again, in a region where not everybody has a bank account, many people have learned to rely on this service, which, if anything, it kind of makes their business a bit more sticky. So far, if you think about what we have, they have a kind of all-encompassing network. And I think that's their real advantage, is that if you want to sell a product, well, they'll do the shipping for you. They will store the products for you. They will get it to the customer. They'll allow the customers to process the transactions. Everything can be done through their network. And this is extraordinarily empowering for them. Now, beyond just processing transactions, they sell insurance. They recently started offering credit cards. So there's a lot that this company is doing that could make them very, very powerful. Now, one minor red flag, if we want to call it that, Okay, so here's how I want to summarize the potential red flag to keep in the back of our minds if we do decide to invest in this company. And that is, let's say, the credit risk behind this business. So, as I was reading through and doing all the research that I could for this company, try to understand the way this company works, I, of course, came across that they sell insurance, they issue credit cards, all of that stuff. Well, just stick with the credit card example for a moment. If you get a company like Apple, Apple has it, the Apple credit card. But the bank behind the Apple credit card, from my understanding, is Goldman Sachs. So if you take out an Apple credit card, if I have an Apple credit card and I don't pay, well, Apple doesn't take that hit. Goldman Sachs takes that hit. Goldman Sachs has to carry those assets and those liabilities and all the banking side of the business. Goldman Sachs has to deal with that. Whereas Apple is kind of the middleman. It's kind of the branded version of the credit card, but they're not fiscally responsible for the credit side of it. Well, with Mercado Pago, their credit card, there is not a bank behind it. They are the actual lender. So they are offering a line of credit to, if I got one of their credit cards, well, I am borrowing the money from them. If I don't pay, they are taking the hit for that. Now, this in and of itself is not fundamentally a problem. But if we think back to times like the financial crisis, well, the financial crisis where credit got a bit out of hand. If credit got a bit out of hand in this case, in this region where, this company was issued a whole bunch of credit cards, well, that could dramatically hurt their business. Now, at this point, I don't think that is a risk, but that is mostly because this is a new side of their business. A company that this reminded me of when I was doing the research was a company like General Electric. General Electric was the dominant player in their industry. And then at one point, GE Financial became a big part of what they were doing. And they essentially started doing a lot of things that banks do, kind of like this line of business. And that ramped up their revenue growth, profit growth. The margins on credit cards tend to be fairly good as long as everybody pays. And GE Financial ran that company up so big, but when it imploded big time and it took GE down with it. And GE ended up having to break itself up and all that stuff. Now, again, I don't want to say that is where this company is at because I very much so far like this company. But I just want to bring this out is that if I do decide to invest in this company, well, this is something I'm going to keep in the back of my mind. If they start loosening up credit, if they start giving out tons and tons and tons of credit cards, that will be a red flag for me. So just something to keep in mind. I apologize for the kind of early red flag within the video, but I do think it's important. Okay, next we're moving on to Mercado advertising. Now, this business is actually fantastic because basically, again, kind of like Amazon, that you can advertise you sell a product, you can advertise, move it up. The advantage there is that there is a good profit margins in advertising. Once you set up the whole structure, a lot of the revenue you bring in from that goes to the bottom line. The net income profit margins for that particular line of business tend to be fairly good, certainly versus like the retail side. So I think this has a long runway. There's a lot of potential money to be made here. So I think this could add some serious growth to this company over the next, let's say, decade. Okay, now let's jump in and look at their regional segments. So as far as their regions go, they're actually in about 18 countries, although most of it is dominated by 3. So in Brazil, that generates most of their revenue. Well, you got some competitors over there. You've got something like Amazon or Shopee. Those companies are down in Brazil. But these guys do fairly good. They're pretty much going head to head with Amazon for the leadership role there. Then we have Mexico. In Mexico, you have Amazon's down in Mexico. You got Walmart down in Mexico. But again, Mercado Libre does a pretty good job of competing there. Then Argentina. Now, Argentina is actually where Mercado Libre started. And they have a near monopoly in Argentina. From what I understand, there's like local retailers and then there's Mercado Libre. It's the only place to go. Now, one thing to keep in mind in a country like Argentina is, one, their population is smaller relative to some of the other countries, but also their inflation rate is extraordinarily high. Last year in Argentina, they had over 100% inflation rate. But what has been interesting about that is when I was reading some publications from down in that area, they were talking about how some workers at different factories and different places down there would get their paycheck from, whatever company they worked for, and they would automatically put that into their Mercado Libre account or the Mercado Pago account, I suppose. Is it Pago or Pago? I don't really know. But they put it in that account to help try to stabilize what they're doing. So I think that this could, if anything, again, this speaks to the long-term prospects of this company. And I think that they're very well positioned in the Latin American economy. That being said, let's jump over and look at some of the numbers. So this is a chart of revenue. And we can see that revenue over the past few years has ramped up beautifully. In fact, coming out of COVID, they really exploded. They were kind of inching along and moving up, as we can see here, but then they exploded coming out of COVID. Now, one of the things I think is most important to remember with that, and why this company is not like a company that, kind of like a Zoom call type of thing that did extraordinarily well during COVID, but then when COVID went away, yeah, they were doing better than they were before, but it wasn't as necessary because some people, went back to the office. Well, this is a little bit different because when COVID happened, one of the things that happened is it kind of forced a lot of people that didn't do online shopping or online banking or any of that stuff, that never did that stuff. Well, suddenly they had to because the banks and the shops were closed. So they kind of were forced into doing that, into getting on board. But what that increased was the adoption rate down there. So now more people did it and they kind of got used to it. So you ended up with much stickier customers. So basically, it just accelerated the adoption rate of their products and the services that they offer, which I think, again, is a good sign for their overall business. I think that revenue looks fairly stable. In fact, over on the Investors Grow website, we have a stability score. And basically, the way these scores work, we have a stability score for a few different line items, something like revenue, something like net income, free cash flow, things like that. But basically, the higher, the better. It's a way to measure the consistency of the growth through the years on a rolling average. Higher is better, hundreds to highest. It's looking fantastic. So from a stability score, revenue is doing very good. Now, some of their other numbers are a bit more unique. Here, we have gross profit margins. Over the past decade, gross profit margins have actually drifted lower a little bit. Now, gross profit margins, just so we're on the same page, this is after the cost of goods. So after the cost of goods sold, what is remaining? And they're doing fairly good. If we're curious, I compared this to a company like Amazon. Amazon last year had gross profit margins of about 49%. So they're right in line with, let's call it, the industry average. And I expect their numbers to be a bit more volatile as they continue to expand the number of products that they're offering and things like that. But some lines of business, for example, advertising, will help increase this. So I wouldn't be surprised. I would expect we'd end up somewhere in this range, between 45 and 50% gross profit margins over let's say, the next decade. Okay, now let's jump in and look at net income. Now, net income obviously doesn't look nearly as pretty as something like revenue does. But I do want to point out that this setup that we're seeing here is often very common. So oftentimes you will see maybe it's net income, maybe it's free cash flow, but the number will start to drive lower. Many times it goes negative. But you'll see kind of that downward shape and then it spikes up. And if you think about it, this often makes sense, especially for smaller companies. It drives lower because they're spending a ton of money trying to maybe set up their logistics network, trying to expand into new products, maybe expanding research and development. They spend a whole bunch of money, and then in the coming years, well, the money that they spent pays off, and net income starts ramping higher. So overall, the fact that net income is now climbing higher and now economies of scale can start kicking in for them, well, this is likely to be a good sign for net income over the coming years. We're seeing practically the same story when we jump over and look at cash flow from operations. They've done a very good job of increasing cash flow from operations, which is good. And that translates directly into free cash flow. So you take cash flow from operations, you subtract capital expenditures, and that's one way to come up with free cash flow. And free cash flow, again, since 2020 especially, has ramped up nicely. Now, when we look at, this is another stability score from the Investors Grow website. When we look at that, this is their net income stability score. And I think that this is important to notice here because you'll see the gap in the middle there. That gap is because, well, they weren't profitable, so it wasn't at all stable. But since then, it has ramped up. Now, while we saw revenue was consistently in the high 80s, low 90s level, which is excellent for a stability score, this one is just starting to get there. I believe that over the coming years, this number will continue to ramp up or at least maintain these higher levels. I think that this higher stability, the higher growth for net income is likely to remain because some of the products that they're pushing out are going to generate a lot of net income. Think about all the credit cards, all the financial stuff, all of their advertising business. They're expanding their geographic reach. They're expanding the logistics network, which will really be expense, but will ultimately help make the customers a bit more sticky. So overall, I think that the net income stability and free cash flow stability is likely to do fairly well. Now, with that being said, let's now look at free cash flow with analyst estimates. The green bars are analyst estimates, and the blue bars are historical numbers. And we can see what analysts are projecting for free cash flow, and we can use these numbers to try to come up with a fair value for Mercado Libre stock. When we take these free cash flow expectations and they get entered into our calculator, well, we can see that we end up with a stock that's about fairly valued right now. So right now, it looks like it's overvalued by about 2%. And this implies that what we'd like to see is a little bit of a pullback in this stock. The stock has done extraordinarily well recently, and we'd like to see a bit of a pullback in this stock before we jump in and buy it, depending on how much the 8.84% implied return. The idea here is that if you invested in it and it eventually traded at its fair value, well, you would return on average 8.84%. That is the required rate of return that would make the two numbers line up, the fair value and the current price. Well, if that's the case, if 8.84% is enough for us, well, then maybe it's worth investing in here. For me, on a personal basis, I'd like to see this one pull back a little bit before I jumped in and bought it. But this is a company I want to add to my bullpen, and I am considering it in my high quality portfolio because I think that over the long run, over the next few years, I think that this stock has the potential to do very well. But as far as my long-term buy and hold portfolio, I'd like to see this one pull back. I need a bigger margin of safety for that portfolio. So I want to see this one pull back just a bit. If you want to sign up to get access to the Investors Grow website, where we try to make it quick and easy for people to value companies and analyze stocks, well, I will leave a link right here, a link in the description below. And thank you so much for sticking with me all the way to the end of the video. I really do appreciate it. Thank you, and I'll see you in the next video.